Well, our speaker tonight is one of the top agents in the Spokane Coeur d'Alene market. He is the owner, CEO, founder of the Spokane Coeur d'Alene Home Guy Group, right?
Correct.
He's in over $39 million in real estate transactions, and he represents a lot of investors here in the Spokane Coeur d'Alene market. I met Brandon about 7 years ago. It was 2006 when I met him. He was working over at Exit Real Estate, and I had started a company there with Lene Thornton. Lene and I were doing a lot of short sale business. You may have saw our shows on TV way back then. And so we were doing a lot of pre-foreclosure, helping homeowners avoid foreclosure. And I was so impressed with Brandon when I met him. We started talking. We went on to develop a piece of offer writing software together, which did very well. And since that time, he has just exploded. His business is growing by leaps and bounds. And we wanted to bring him in, introduce him to you guys, because if you want to buy and find the best deals in this market, he's the guy to teach it to you, and that's why he's here tonight. So if you would, please give him a big round of applause and give him
How's everybody doing today?
Good.
Good. I'm going to pass these around. We'll collect them at the end. What they're going to be are information forms. Just take one and pass it down. And it'll help us get in touch with you to get you investment deals, properties that come on the market, distressed homeowners that we run into that might not be MLS credible, or something we can get directly onto the MLS. So at the end, we'll ask for those. If you're interested, please turn them back in. What I'm going to talk about today is I'm going to go over a few things in the Spokane Coeur d'Alene markets, basically go over what we do as a team. One of our pillars of business is investing and helping investors find investment properties, and we've got a few examples here that we're going to go over. We also are going to go over current market conditions in Spokane, Washington, and northern Idaho. And then we'll do some projections moving forward based on some national trends and some information that we've collected. We're also going to go over some recent flips we've done, and then we're going to apply those to Kogo Capital money to see how those flips could either have been done better, or where you could leverage your money if you have less money than maybe some of these investors did, and then turn that into more money over time. So, if anybody's been watching the news, you've been seeing quite a few indicators of opportunity out there. One of the ones I saw, I think it was last week, was David Blitzer, chairman of the index committee at S&P. He's quoted as saying the housing is clearly recovering, and that was basically based off of indicators that are traded through the stock market that are based on housing. He's seeing a lot of, and just like we are in this market, we're seeing a lot of positive changes. I'm hearing it a buzz. Had a drink with a lender last night, and he said that they're as busy as they've ever been in the last few years. They're writing loans. They're getting people pre-qualified. And as an investor, what that means to you is your exit strategy in your property is getting, it should be quite easy if your property is priced right, because the opportunity to sell a home and buy a home has never been greater, because we've got the lowest interest rates we've had in years and some of the lowest prices we've had in years. I actually met with the builder a few days ago as well. They're exploding. They actually had to buy extra lumber inventory because the prices are starting to climb because of increasing demand in the building, and a lot of that is driven from transplants to the area. So what we're seeing is people are moving from out of areas. They have good jobs. They're buying new homes. They're buying homes that are fixed up, ready to go. In fact, he said one whole block. And in one of his developments was nobody knew. Nobody from Spokane, everybody knew, everyone transplanted in. So basically what I call is a little perfect storm of affordability. We have interest rates in the mid-3s in many cases, sometimes lower depending on what type of loan you're doing. And we have the barriers to entry on the loans are very low. So we're at 3.5% if you're in a USDA market, like some of North Idaho is and some of eastern Spokane County. You're going to be in a zero down type of a situation. And investors in that situation, you're able to appeal to a much broader range when you exit your property, when you're selling it. And so what we look for is an opportunity for an investor so where you can end up in a position where you have the most amount of buyers to appeal to. I say this with a lot of optimism in our market, but I'm cautious still. I want to make sure that we make good investments. I want to make sure that we're doing our due diligence. because it's still easy to make mistakes. You got to be careful, and you got to have the right representation when you're purchasing a home. I did a trend. This is a trend of the absorption rate for Spokane County, and we did it. If anyone's familiar with the absorption rate, we did a 12-month rate of sale calculation. So we went back to have a 12-month trend, so that we could get a really accurate, an accurate measure. And as you can see, we've had a fairly stable decline in the inventory rate in the Spokane County area, and this is just all properties in the Spokane market over the past year. And you see, we've had about an 11-month trend of improvement in the market. Some economists will say that between a 3 and 6 month inventory level is what you would call a balanced market. And so that's giving an equal pull either way. This, generally speaking, is for the entire MLS, but when we look into distressed properties and properties that need rehab, we're far from a balanced market. We actually see it more into a buyer's market, especially because a lot of home buyers can't afford to do the rehabs on some of these houses that are so far distressed or so far, roofs can be detrimental or they can be cost prohibitive to some buyers. And like I said, it's a period of about 11 months of improvement in the inventory levels in the Spokane market. We trended the Coeur d'Alene absorption rate and the data I got from the Coeur d'Alene MLS. We also have a similar improvement rate. However, we're still above the 6-month mark in a lot of cases, still indicating, generally speaking, a buyer's market and a lot of price points. We are seeing some scarcity in some price points as far as finding some qualified buyers' homes in the $400,000 to $500,000 mark. We're finding some troubles. We're also seeing improvements in demand. We had some of the best months in our Spokane and Coeur d'Alene markets that for November through present day. We've had some of the best markets we've had for buyer demand and buyers actually stepping up to the plate and signing on an offer. And so we've actually had quite a good success with some of our investors that we're working with on their flips. One of our recent flips we sold in 7 days for almost full price. Again, I highlighted the over 6 months of inventory on there. I anticipate we will get a little bump for February because a lot of people start putting the inventory starts bumping up every year in early March, late February. You may see a tick, but I believe the demand is going to stay solid as so long as our interest rates stay pretty good. I track a lot of data. One of these data, this is a National Association of Realtors publication. It goes over a comparison of Spokane market to the national market. They say that we had about a 5.1 appreciation rate in Spokane market. I don't think it was quite that high. I think maybe some price points, some locations may have seen that. We still saw some year-over-year declines for some clients, and a lot of that was either there was poor expectation last year, or we were still working off comparables that might not have been quite comparable in neighborhood. But with a lot more inventory moving, we're getting a lot better picture of what things are worth. I did a background check on some of these facts. A lot of times the appreciation rate is tied to an index, a national index, and then it's applied to a average or the increase in the average sale price. And a lot of times what we like to do is compare that to the average square footage price and make sure that we're not just selling larger homes for less money or just a little bit more money. And so I do think we had about a 2 or a 3% appreciation rate. We did have some, but I don't know if we were quite 5 yet. 5 would be a pretty stellar year. So. A couple other good things overall the Spokane markets remain strong. If you look at the average over the past 36 quarters, and we've seen a huge increase in equity versus the U.S. national trend. So Spokane remains strong. It's a great place to invest. It's a great place to own real estate, and it's very, it's quite a bit higher than the national average. We took a look at the average sale price comparison for Spokane County, and I've got one for Idaho as well. If you'll look here, if you take the difference between the average sale price in 2011 in December and the average sale price for 2012 in December, I mean, there's quite a big gap there. We see a market improvement. If you look at through the year, it was only 1 month that we were actually on par with the previous year, but every other, except for these first 2 where we got our start here, except for the rest of them, we just took off. And then if you look here, this little turquoise dot up here, that's this year. That's 2013. We're already starting off at the similar levels to 2012. So there's been a definite change in the market. We're seeing the average sale price increasing up. We're seeing higher demand. We're seeing a lot more activity out there. So far, excuse me, when we look at the active listing trend, which is like that inventory trend from the absorption rate, we look at the average active listings being quite a bit lower in the Spokane market than they have been in previous years. And in that again is decreased inventory and with increased demand, you know, can put upward pressure on prices. And so that's what we're kind of seeing with that average sale price creeping up there a little bit too. As you can see, the active listings for 2013 is actually quite a bit lower starting out the year now. So our inventory levels are creeping back down and prices are creeping back up. And this has only been a 3-month trend. We've only had 3 months of good news. I'm not going to jump around in the street and celebrate yet, but there still is opportunity right now. There's opportunity to happen. Talking with a couple investors from the morning meeting, we actually have the market working with us a little bit versus against us as it did early on as the market was still in a decline. We have the market doing a slight appreciation, so we're not actually losing what we're holding in many cases, it's a great opportunity, especially with the ability to easily move the property and with the market interest rates. Idaho didn't have a really accurate year-over-year comparison, and so we've got just the previous 12 months here for the number of active listings, and then we did pull some sample data from the MLS and graphed it as well, and it is quite a bit lower, and we're on a decline of number of listings. We typically see an annual decrease in listings in the wintertime for most markets up here in the Northwest, but you can see that December, January, I mean, it is quite a bit lower than we started out in February, so we're actually on a downward trend there, and year over year we are quite a bit down on inventory there too. Not quite as significant as the Spokane market, but anyone who's done business in both Washington and Idaho they are very distinct markets. Even Post Falls and Coeur d'Alene are very distinct markets. I did a few market projections. I will say I did this cautiously with my crystal ball, and it could be much better than this, but I think if we average out the next 5 years, we're probably going to see some ups and downs. I anticipate a stable to less than 1% appreciation or a plateau for the near term, generally in the Northwest area. We may see some areas increase quite rapidly, and some of those areas have been being worked on for a number of years, even prior to the downturn in the market. But overall, I don't think we're going to lose large digits or large amounts, large percentages of value going forward. I think we're going to stay stable, but I think we'll have our peaks and valleys as we go through and get out of this, because we still have a lot of things to fix nationally and politically to make sure these all happen. They extended the Distressed Property, the Debt Forgiveness Act, and what that tells me is the federal government still believes there's quite a bit of distressed inventory out there, namely short sales. And if you're not familiar with this act, it was an act that was passed to help alleviate the tax burden on the forgiven debt in a short sale, and it was set to sunset at the end of 2012. Or in the first few weeks in January, and the fiscal cliff, they actually extended that act. We actually had a bunch of short sales that we were working on affected by that, things that people weren't going to close because of it. But the federal government must have some knowledge in there. This is part of the backup of why I think we still have a little bit of time to get out of this market. We're still going to see some distressed property in here, and that's where the investors need to come take that pain away from the market, rehab those properties to the end buyers. One thing we're starting to see is early 2008, 2009 short sale and foreclosure sellers starting to re-enter the market. And these people were people that lost their home either to foreclosure, or we conducted a short sale to sell their home. And now with their credit getting better and their financial situation getting a lot better, most of the time their home was their largest piece of debt, and then once they quit paying on their home or didn't have to pay on their home, they were able to pay down cars and other debt or other methods. And they're re-entering the market now with their credit is getting back to a point. So we're still seeing another section of demand coming back into the market. And these people are especially going to be the people that need in many cases, your 0 down or your 3.5% down FHA to get into the market. So there's going to be a steady demand of buyers from within our own market, in addition to the transplants moving into Spokane. And then obviously the stable demand is going to be tied to employment and interest rates. Based on, Spokane's been pretty good on their employment rate. We've been, fairly steady. There's quite a bit. There are quite a few jobs in Spokane that pay a living wage in Spokane, and you can actually buy a home with most of the jobs that you can get in the Spokane market on that. So we have a little bit of a list of what we've gone through here. Is we've put together a few scenarios on what the Spokane market and when some Spokane investors are doing. What we'd like to do is go over a few of those scenarios, and then I'll ask for some of you to discuss some of the deals that you guys might be working on and see how we might be able to relate some capital to that. But first, we're going to go through a few examples. If you have any questions through this process, just raise your hand and we'll get you going and do that. In this case, we had a distressed landlord. She owned the property outright. I found her through my prospecting, my phone calls that I do to find investors, and I also find distressed properties. We ended up finding her. She had inherited the property, had a renter in it. The renter trashed the place. It was a few $1,000s worth of dump fees, in addition to an amount of work that was insurmountable to her and her budget. And so we came in, we worked on a deal. I said our best option is to market this to an investor, and so we put it on the market, and then we were able to find an investor for the property. And then I'll talk about the flip that we did based on that property, because we ended up selling the property again. So listed the property at $72,500. It was over market, but we wanted to get some time on the market to feel out some of the investors and see what kind of offers we got. We ended up getting the property purchased for $55,000. And the investor did a lot of work, put $20,000 into the property. He did some really important things, like dressed up the front. It looked like an entirely different house. It looked like the inside was brand new, some new appliances. It looked pretty nice inside, but he did not go beyond the means of the neighborhood. It still looked nice, and it still was comparable to the neighborhood. So we had a $75,000 investment into this property. On the sell side, we put it on the MLS at $114,900. This property was ready to go. We started getting showings almost right out of the gate. We had it under contract within 87 days at $102,930, which was our projected ATV. Our ARV was 105 on it, but we did list it over market. We paid some buyer's closing costs, and I would budget these into a lot of your flips, namely because a lot of the buyers in this price point really need that. They're in many cases borrowing their down payment from a relative, or they're scraping it together to do that. And so closing an extra 3% in closing costs is sometimes prohibitive to them, and we want to make this opportunity to purchase your home open to as many buyers as possible. Profit from sale was $24,842, and we didn't include selling costs in this, as they might vary, because depending on what type of relationship we have with an investor depends on what type of a fee structure we have with them. If we have an investor who's doing a dozen transactions a year with us, we definitely have a better fee structure with them, because our goal is to be with somebody long term and make it profitable for the two of us. If we can get a full pay on the front end of the deal, we can do a deal on the list side and help keep the costs low and keep that profit rolling, because if they can keep leveraging that money, they're going to keep buying homes. And some of our investors, will try it by themselves on the market or on Craigslist, or self-market some properties prior. We'll have an agreement after 30 days or 60 days. We'll list it and take it on. So we like to keep that calculation that way. This was a short sale, one of my favorite ones. The list price was $99,800. Purchased the property for $75,000. Put a $25,000 investment into it. So we had $100,000 into this property. And we listed it on the MLS for $169,950. We had it under contract in 7 days for $168,500. We had a little bit of money to spare there, so we paid some closing costs for the buyer to sweeten the deal. And potential profit before cost was $63,445. And this flip took place within a matter of a couple of months. This was an example of Aaron. Aaron finding an Aaron, he's back there. He was back there this morning. He's found an opportunity in the market, and we were able to jump on it. It happened to be a short sale. We did have to wait a little bit of time to get it, but we didn't have to spend any money while we were waiting. But when we did get it, we got it right. Another one, 86.5, purchased for $85,000. This seller put a lot of money into his property. So we had a total of $130,856 into this property. Put it on the market at $164,900. Under contract in 5 days. The buyer financing failed within the first week. We got a notice. We sold it again for $162,500. Paid some closing costs, and his profit before cost was $26,769. Going back, these have all been within the past, I would say, since November that we've done these. Some of them we had acquired right before November, and we flipped them over the winter, but most of these have happened in the previous 6 months. In fact, all of them have. Another property, $122,900 was the list price. We got it for $121,635. I don't know who picks those numbers, but $121,635 was the magic number. Did a $17,000 investment, so we had $139,216 in. Our sell, we listed on the MLS for $164,900. Had it under contract in 22 days for $155,500, and this was after an appraisal adjustment. Paid some closing costs, and even though we had a bump in the road, we did our planning and we had contingencies in place, we still had a positive profit. And a lot of times in this situation, we eat that with the investor, depending on what our agreement is and how many they do with us. So, but the investor still was somewhat positive in this transaction. If he had been paying a full 6% and a bunch of that, it wouldn't have looked so good. But working with us, we have contingencies in place to leave enough money that one or two little mistakes can happen. We hedge our bet a little bit in our purchase. This is a current project we're having on. We're actually battling an offer back and forth today. List price was $84,900. Purchase property for $64,846. $20,000 into it. See, we're into it less than they were originally asking, the property after investment, which is a great position to be in. We listed it on the market, $129,000, and we listed that about two and a half weeks ago. We're currently working on an offer with an agent in the 120s, and our potential profit is $44,000. We end up paying some costs. We're in the mid-30s. On that and do some negotiation, but still, this is the same investor that did the $63,000 one. So in a matter of 6 months, somewhere in the ballpark of $100,000 in profits from flips. So I'm going to relate a couple of these to Kogo money because I think you could do even better, even because a lot of people may not have the money to put down $100,000 and buy a property right away. They may have something less than that in a 401k or in cash or an inheritance or they have a partner, and they also have a program for a zero down, a way we can organize the deal that way too. So what we're going to do is we're going to make a few assumptions so that we can work on a level playing field. And when you work with Dan or one of the Kogo LOs, that they'll work through the scenario with you as well based on what you're working on. Let's just say on this first scenario, you've got $40,000 to invest. Your bank said no, obviously, because Kogo says yes. And you need to leverage your money, and Kogo says yes. So let's take that short sale property, the list at 99.8 and purchase for $75,000, and assume that we got an appraisal for the Kogo loan at $90,000, which in my opinion was fair for that property in the condition that it was originally acquired in. So at $75,000, the purchase price, the seller pays some costs, because we'll ask for those costs so you can cover your points and minimize the cash out, so your cash is going straight into the property and creating value and profit. $58,500 finance with $16,500 down. $23,500 left for rehab presumes that you carry the loan out of your current cash flow, and you sell for $168,500 minus some closing costs, and you've turned $40,000 into $103,445 less your carrying costs and selling costs in 2 to 3 months. And so if you just had $40,000 sitting around, you're not going to buy a property and rehab it and make that kind of money. You're going to buy you'd have to have room for your rehab. You'd have to have purchase room. So you're going to have a $20,000 investment, maybe $20,000 in rehab, and you're probably not going to make anywhere close to that return because it just doesn't exist. But leveraging your money short term, you can turn a $40,000 pile of money sitting in your bank account or 401k or wherever you've got it into $103,445, take out some of those costs, and make a decent profit. So they've got a couple different LTV standards. Basically, it's 65% of appraised value up to 80% of LTV, and assuming that's under the 65% value there. In this case, let's just say on this new scenario we're going to do, we'll borrow $58,000 on a property we're purchasing for $75,000. So I'm going to say I have even less money. I've got $20,000. So we all know I'm not going to purchase and rehab a property for $20,000. So I need to leverage that money into more and see how much more I can make. We'll go back to the distressed landlord. She owned her property outright. She's an ideal candidate for a zero down or a low down situation. Our list price was $7,250 and we purchased it for $55,000. And we'll assume a $60,000 appraisal, which is in the ballpark of where our comps landed originally. In this scenario, like many others, she owns the property free and clear. This gives her a lot of flexibility for you and for her. We'll get her to pay the closing costs so that you're totally nothing out of pocket, and that $20,000 can be saved for investment rehab. So we're going to take that $20,000 and sock it into the property. We're going to invest it into $20,000 and we'll carry the costs out of our current cash flow. We're going to list for $114,900 and sell for $102,000 and pay buyer's closing costs. And we've turned $20,000 into $44,000 less selling closing costs in under 4 months. You couldn't have done this previously with $20,000 unless you leveraged that money out and put it in the right place. There are a couple different options you could have done. We could have done completely zero down, and even if you had zero money, and this takes a little bit of finesse and some negotiating on the part of you, between you and the seller, but if you can get a seller on board with your reputation and your previous experience as a flipper and show that you can create value for both of them, you can take and do the 65% of, you can finance the 65% with a first mortgage with Kogo, get the seller to carry back the 35%, and then have the seller become your investment partner to help fund with that first 65%, and actually have the seller split the costs, split the profits with you at the end if they're interested in that. and sellers are interested in doing that. This particular person may have been a good candidate for it, and we didn't ask them. We had a buyer already. However, in this situation, a lot of sellers, especially in this, don't have the know-how or the means. I mean, she didn't even know she probably could have gotten a rehab loan through Kogo to rehab her house before she sold it. And so a lot of these opportunities exist out there, and if you can have a conversation and create a value proposition between you and the seller, you can work out a number of great deals. And it was win-win, because it would have been completely on the table and profit sharing on that. So I'm going to go over that last deal. Kogo capital loan for $39,000. We did a seller carryback mortgage for the remaining 16. Alternatively, they also have resources of partners and gap funders that can help you fund that gap. Or you can find an investment partner to work with that may have a property or a piece of property as collateral that they can get a first lien on for that balance too. As long as they can lien a property in first collateral and it has an appraisal, they can work with you in most cases. And so we've got the ability to get a completely zero down loan. These take a little bit of finesse, and it's a great way to get started, and then you get a little bit of capital and we can begin leveraging that at a big scale. If you like what you've seen here today, we'd love an opportunity to work with you in a consultation mode. What we'd like to do is we pass around some of those forms. If you're interested in receiving, we track investment properties in the Spokane Coeur d'Alene markets. We can email those to you, and we'll help you get set up with Dan and everyone to finance. So we've got if you don't want to fill out the form or you change your mind later, we can go to flipspokane.com and we just have a little web form on there. We'll get right back to you. If you turn in your form here, we're going to actually get you some listings that we have, start getting you in the loop. We'll get you in touch with one of the talented Kogo guys to find out about how you get a chunk of that $15 million and see what we can do to start flipping some properties. If you have special requests, I have that whole section on the bottom. Like if you need some help getting started, you're interested in some classes. Kogo's got quite a few classes they're doing over the next 12 months here, so be sure to be there because you're going to learn a ton from the people that they bring in, and actually be here for the next 3 or 4 days to see some of the talent they're bringing in here, and you're going to learn a lot. You're going to learn a tremendous amount. It'll be worth your time. So. And there's sandwiches in the back. So, if there's no other questions, feel free to contact us anytime. We'd love to work with you.